Good afternoon. I hope everyone is doing well. Welcome to the next episode of Lumida Non-Consensus Investing. I'm Ram Alawalia, the founder of Lumida Wealth Management. I promise I do a live podcast today. There's so much happening. I wanted to share some thoughts with everybody. By the way, quick heads up, I'll be in Puerto Rico Tuesday through Thursday of this week. So if anyone is in the Dorado or San Jose area, do reach out. We're also doing more events in the New York City area too. So find a way to get a hold of us. I want to share a few quick thoughts on the market. If you've been reading my newsletter for the last 2 weeks, you've probably have seen some of these updates. I'll share my headline views there and also walk through specific stocks that we own right now, have been buying, including this morning and over the last 1 or 2 weeks or so. So look, my headline view is the bottom is in. And I don't think that is a consensus view out there. People wake up, they see headlines, their cortisol is spiking, they see the price of oil, they look at the price of gasoline, and they've got PTSD and fear in their bones. And so very much what we see today is very similar to what we saw last year. I'll share some points of reasoning, and then I'll get through some of the positioning ideas we have. First off, last Tuesday, I posted on Twitter, I said, I think you should be buying stocks. There's lots of value. Their names are down 20, 30%. What drove that thesis was a few things. One is, this is the headline, we see quite a few quality businesses that are trading at significant discounts, where if you're an investor, you're supposed to buy those businesses. These are called quality businesses. I've been very critical about the concept of quality because they were overbought and expensive, names like Costco, which are still expensive. But there are a number of high quality businesses that have economic resiliency, pricing power. They're dominant, market leading franchises with brands and capital and earnings growth. And they're cheap. And they haven't been this cheap in a long time. So when that happens as an investor, you're supposed to buy. And I see dozens and dozens of these names. This has been a really unusual kind of correction where you've seen concentrated selling in certain areas and then rallies in other areas like energy, materials, and staples. So the volatility under the hood has been a lot more significant than you see at the headline level. So the move now is to buy those names that sold off quite a bit and prioritize on quality. What happened the last 2 months is significant, what's called degrossing, deleveraging from institutions, but also retail investors. And they were forced to sell quality names just to make their book smaller. And now when they get back into the market, they're gonna have to buy those names. We saw excess fear as well. Last Tuesday, I saw that retail investors bought an excessive amount of puts. That's a pretty reliable bottom signal. When retail investors are panicking, you want to take the other side of that. We also saw excessive hedging and excessive short interest. If it wasn't for that, you could say maybe the bottom's not in, but institutions have bought so many put options, they've hedged so much that we're seeing record levels of short interest. It's hard for markets to move down when people are expecting downside. This is classic non-consensus. You want to take the other side of excess fear, okay? Are there issues in the market? Sure, there are issues in the market. Private credit's a legitimate issue. Does liquidity risk become credit risk when these software companies can't refinance because their equity values are down a lot more? Sure, there are risks out there, but they're quality opportunities. And even when you look at private credit risk, I see commercial bank lending is increasing. People don't borrow from banks unless they intend to use that capital. Banks are still lending. So the basic drivers of economic expansion are still there. Household balance sheets are still strong. They still have record equity levels. Their house prices are increasing, which increases the value of their balance sheet as well. If you're on the lower side of the K-shaped economy, it's a very difficult time period. As you see gas prices going up, you're getting priced out of homes. You're going to see more inflation, but that doesn't drive the broader economy, okay? That cohort doesn't drive the broader economy. That's important to keep in mind. Some other things that we were looking at, we got cautious and bearish in January when we saw that everyone was all in the market. the Goldilocks thesis, which we were champions of really the last 2 years, became consensus. And you saw the Bank of America Fund Manager Survey showed cash levels were low. We saw multiple studies. The AAII Investor Sentiment Index showed people were ebullient and optimistic. So, we've reset a lot of that sentiment now. You're back at kind of neutral levels now. So markets can rally because institutions have more cash. Not only that, what you now have are a condition of FOMO, fear of missing out, also called like a performance chase. If you're an institutional investor, it was smart to get out of the market. Now it's silly not to be in the market. They kind of have to get in the market and participate. So I think the move here is front running these institutions, because those institutions are trained to buy quality investment. This is the time when you want to put CFA hat on, okay? This is the time where you become Mr. CFA. I'm going to walk you through what we've been buying now. Again, take a look at our newsletter this weekend if you want a little bit more information on what we saw, big picture. So category-wise, look, Mag 7, really Mag 3 led us into this downturn. I think they're going to be some of the names to lead us out. I think they're going to do really well. Take a look at Microsoft. This is a quality business with double-digit earnings growth ahead of it. Microsoft sold off due to counterparty risk on OpenAI. And in November, I was highlighting this. They had too much exposure to OpenAI. But the impairments, their equity, are hundreds and hundreds of, like $800 billion in losses versus only $100, $200 billion exposure to OpenAI. Markets overreacted here. This is a quality business. They're going to raise prices in May, and they're having like a $95 a month pricing for bundling various services. And Microsoft will fast follow Claude, just like they did with Netscape Navigator when they rolled out the Internet Explorer browser. These businesses have substantial enterprise distribution and reach. It's really hard to underestimate that. And they've got lock-in from Fortune 1000 companies and governments around the globe. If you want to see one of the greatest earnings transcripts of all time, just go read a Microsoft earnings transcript. Their tentacles are everywhere. And people use Microsoft because of security. So it's a great franchise. They'll do well. This is one of our largest positions. We hadn't owned it for years because it was overpriced. We own it now. I think this is a fine business, and I believe it bottomed with the software category this past Friday also. That's one of the names we own. So Microsoft, that's a name. What about names like Accenture? I think this is a great category opportunity. Look at the free cash flow yield on Accenture. This is 11% of free cash flow yield. Free cash flow yield is one of the few metrics that's a reliable guider of where there's value. This is a quality business. AI is not going to disrupt these consultants. What these consultants are going to do is facilitate change management. Enterprise companies, they need to change their workflows. Workflows are how organizations adopt new technology. They've got to map out the old process, formulate a new process, then drive behavior change and training and new policies, new systems building. They've got to sculpt AI around that business and their specific workflows. And companies like Accenture, and they're not alone, by the way. Companies like Cognizant Technology Solutions will also do well. It's got a free cash flow yield of nearly 9%. You'll notice this is near the highs. This is near the highs of free cash flow yield, and the valuation multiples are near troughs. So look at this. If you're a value investor, this is like your CFA test. You're supposed to buy. We own both of these names, on both, full disclosure. I think these will do well. I think these will do quite well. I think you wait a year, and these are up at least in the teens. The death of SaaS was truly exaggerated. We'll get to SaaS in a moment too, but I think these names are going to be part of driving transformation in the years ahead. Okay, some other names in software. Let's talk about software. So look, I think Microsoft is actually one of the moves in software to make, but there are names in software that are still too expensive. They're all going to rally today and probably for the next few weeks, because if you look at software versus IGV, or semis versus IGV, which is the software index, you can see this is quite extended. This is quite extended. It's even more striking. Oops, sorry. 1 second. This ratio of semis to software has gone on too much. This is the AI apocalypse theme in a nutshell. I think semis are likely to give way and top out here, and you can even see it in that ratio today. Software is leading semis today. These two ETFs are in tension with one another. They're both subcomponents of technology sector. The value in software is just becoming compelling now. I look at GoDaddy, for example. Right? They have all the domain name registrars, 15%, 14% free cash flow yield. It's too cheap, 8.5 times forward PE with earnings growth. AI is not going to disrupt domains. People still need domains, and you've got a lot of recurring revenue. Anyone that owns a domain understands that every year you're paying GoDaddy its utility with earnings growth. And I think those guys will do pretty well. Zoom is another interesting one also. Zoom's at 8% free cash flow yield. Not a bad idea. And let me see if I find you a cleaner chart here. Below the 200-day moving average seems like that could be an opportunity. Some other things that we like here. Let me talk about staples. I do believe you're transitioning to a higher inflation world, and inflation is toxic for risk assets, toxic for bonds, toxic for equities. Anyone that remembers 2022 knows that. This is the primary macro risk factor in the market. It's not earnings growth. The earnings growth is there. We've seen the forward PEs decline 20%. That's consistent with significant corrections. That's another reason why I'm constructive on the market. Even though the headline indices dropped like 8, 9, 10%, the forward PEs dropped substantially more. Where that earnings growth is going to come from is substantially going to be like large cap tech, but also other areas, including financials, some industrials, which I think are overbought and very expensive and should be in a void. But the earnings growth is there, and that's constructive. Staples are interesting because they have the ability to pass on inflation more efficiently than other categories. So you're finding names like Philip Morris. Philip Morris is a dominant market leader. We've been picking up Philip Morris the last 2 weeks. It's got good earnings growth. They have a product in the market around Zyn and nicotine that is doing well. Products are literally addictive. So, that's, the number of names like this, by the way, in the category. But I think Philip Morris is interesting. A cheaper version with more international exposures is British Tobacco. Maybe Altria is probably not the most set up technically here. But I think staples are interesting. They're resilient businesses. Look at names like Clorox. Who's talking about Clorox? We picked up Clorox last week. This thing has gone nowhere in quite a while. It's near multi-year lows, and Clorox is a consumer staple. The free cash flow yields, again, near the high end, 6 points. So this is a nice defensive move. It's better than owning the 10-year or bonds, which can't compete with inflation or they're hurt with inflation. This is not a bad idea. It's very non-consensus. Interesting role of diversification in the portfolio that I think a name like that can add. On the other side of the spectrum, you got Dollar General. Dollar General, also good earnings growth and free cash flow of 9%. That's strong free cash flow. This is near the higher end of its historical average. We think there's some value there. You can see the name is just tucked below the 200-day moving average. Not a bad time. I don't think this is compelling value. I think there's value there. Okay, so I'm trying to draw a couple of distinctions here. This is a name that is arguably losing ground to the Walmarts of the world and the Costcos of the world, but those names are way too expensive and overpriced. These are kind of safe haven categories that are likely to give back. Look at Costco now. It was a beneficiary of this kind of conflict. It's giving back now. This safe haven is going to go away. I think that's an avoid. So as Costco trades down, I think names like Dollar General can trade up within staples. So we like staples. Here's another idea for you. HPQ. Now, I read today that NVIDIA is contemplating buying a PC company. We don't know which one, and this thesis doesn't ride on that. But take a look at Hewlett Packard. I can't stand Hewlett Packard PCs, by the way. I don't like them, but I got to leave aside my kind of product preferences from the investing. Hewlett Packard's got a 16% free cash yield. Again, this is what I'm talking about. We see a lot of value out there, 7 times forward PE. Now, this stock got hammered because of rising memory costs, right? Micron is sold out, rising memory costs. That input cost feeds into the final product cost of PCs. So it's hard for consumers to buy these PCs at higher inflation. But okay, seems like a lot of the bad news has been priced in. It's been relatively resilient to the Iran conflict. It got smoked ahead of the conflict, and it's hard to find sellers, it seems, at these levels, right? Up 5% today. And there are alternative memory solutions coming online, new technologies, right? Don't bet against entrepreneurs, don't bet against capitalism. The cure for high prices is high prices. You're seeing more memory innovation happen. And when that innovation comes online, stocks like this should benefit. I look at my downside on this, I compare it to my upside. It's hard for me to see this thing drop to a 6 times PE ratio. I think the lows are in. I think my downside is somewhere around 18, 17. I think my upside is that maybe this recovers, goes back to at least the 200-day moving average. That seems like fairly attractive risk reward to me. So that's a non-consensus idea as well. How about more software? I think HubSpot's quite an interesting idea. Again, I think you got to pick and choose your spots in software. Some of these database and technology companies still have trailing PEs of 50, 60 times earnings. I don't think that makes much sense. But you have a name like HubSpot. We use HubSpot. Their average sale price is $10,000. People aren't going to switch away from a product that costs $10,000 to an AI product that costs another $10,000. I think Google could buy this company as well. The free cash flow is 6%. We were in this earlier in January. We got in too early. I made a note. We bought HubSpot. We were wrong on that. We then sold out of it. And that was good that we sold out of it because we could have avoided further losses. It's important to take losses early and often. And that's what we did here. But if you look at the volume in HubSpot and other software names, a lot of volume on Friday after 3 smash down days, which look like panic selling to me. I think the sellers are exhausted. Cue the David Goggins meme. The sellers are exhausted. Have you guys seen that? David Goggins running, sellers are exhausted. I think David Goggins is actually exhausted. So I think you at least get a multi-week bounce, and then we can reassess. These businesses are still growing. Let me show you some key statistics here. Let me show you some of the data of what we're looking at here. What's a good visual for me to share with you? Give me a moment here. So again, the trailing P is a bit high. I'm looking at the forward earnings estimate here, but the earnings growth is strong, double-digit expectations. It's good to be skeptical of analysts, but even if the analysts are way off and the earnings expectations are only 20, 30% growth, that's material. You're seeing double-digit revenue growth as well, and they're a dominant market leader in the category. I don't think AI is going to refactor HubSpot. So I think that's interesting. There's some other names in that category of software as well. Intuit is an interesting idea as well. I do think they've got risk on the consumer side, but 65% of the revenue comes from businesses. Those businesses are focused on investing technology where they can deliver more value to the customer. They're not trying to disrupt Intuit. They're not trying to deploy their CTO to take out Intuit. I look at that chart, okay, and I say, gee, this has a shot to bounce right here, okay? This is how you mix technicals with thematics together. It's got a shot. It's a franchise of the dominant market leading brand. People are entrenched in the workflows. Maybe some DIY guy at home decides to do their taxes with Claude, but if you're a business, you're not going to do that. The free cash flow is also attractive. So I've seen some good bargains in software. Again, it's not across the board. I think you do got to pick and choose your spots. I think cybersecurity is overvalued. We used to be long Palo Alto Networks back in the day, by the way. But I think cybersecurity may face continued pressure within the software category. If software rallies, though, all of software is going to rally, right? Those distinctions may not matter in the short term. Other names I would avoid would be things like Workday. Workday, I don't know if you guys saw, the CTO Workday decided to join Claude as part of their technical staff. Workday, you can probably rebuild in a week or two. I'm exaggerating maybe, but our CIO analyst actually rebuilt a recruiting application in 5 minutes using Claude. But this is going to rally like everything else too. Look how destroyed Workday is. Technically, these are just oversold. So the contrarian in me says, I'm supposed to buy these. So the thing about investing is you can have two different views on two different horizons. I think Workday does have legitimate risk around it, around revenue and earnings growth. But it's also oversold. I'm just calling out that there are distinctions to make here. You want to focus on real businesses that aren't going to have AI disruption risk in the category, okay? Let's see, what else? Some other names that we are looking at. Here's another one, Procter & Gamble. It's a boomer stock, okay? 4.4% dividend yield. This offers some defense. It's selling off because staples are defensive today. It's selling off a bit today. But once again, extremely sold off. And I think there's some value there. So I like this in the portfolio because if we're wrong and inflation continues higher and markets sell off on inflation risk, the conflict continues, then Procter & Gamble will provide defense in the portfolio. And if you can buy staples at a good price, it's not a bad thing to do. Look at Warren Buffett's portfolio. Look at Berkshire Hathaway. They love staples. They like staples because they're economically resilient businesses, right? Their end consumer products have low price points. They can pass on inflation. They have brands. They have sticky customer behaviors. So I think Procter & Gamble is an interesting one. Who's talking about these names on Twitter? I don't think people are talking about many of these names on Twitter. These are good non-consensus ideas. Another one is Gen in the software place. These guys, they make Norton anti-lock, Norton antivirus. Cybersecurity is a real risk. It's going to increase with AI. The demand for these services will increase too. People want to protect their assets, protect their wealth, protect their communications. The level of AI hacks we're going to see going forward is going to increase. I think demand for these services will maintain. This thing has a 7 times forward PE. Okay, I look at the chart and I say, gee, I think I'm supposed to go for a dip here and take a look at the free cash flow yield. It's at 14%. These are at levels historically associated with troughs in the stock. It's also got earnings growth. So if the analysts are, it's well below analyst estimates too. If the analysts are halfway right on this thing, if it goes to the median analyst level, it's going to see $30. Let's say it goes to 25. Not bad risk reward. Not bad risk reward, right? So I think we went through quite a few ideas there. We have more ideas too. We can keep going. I think areas to avoid would be things like utilities. Utilities started acting like high beta tech stocks because of the whole AI theme. But what we're starting to see is the next gen of these NVIDIA super clusters don't require as much energy. So names like the IPPs within utilities just aren't working. And I think that's why. Look at Constellation Energy below the 200-day moving average. Constellation Energy, Talon, Vistra, that's kind of the peer group for these IPPs, these independent power producers that have unregulated pricing, have contracts with Amazon, Meta, and other hyperscalers, just aren't doing as well. The demand for energy isn't as needed. Now, maybe solar does well, right? I think Europe is refactoring its energy stack. A lot of countries around the world are looking at the Strait of Hormuz and saying, gee, we have way too much dependence on oil. I think solar could set up an interesting thematic idea and other local energy infrastructure building ideas. That's a category we're still researching. One of the names we own against this is FTI. We bought this after the Venezuela conflict. They provide energy services and infrastructure. It's expensive now. It's rallied quite a bit. We'll see. We still own it, but it is a bit overbought, right? So, but I do think focusing on ideas when solar could be quite interesting. On the commercial side, you've got names like First Solar hasn't really kind of acted well the last couple of months. There's some insiders that are selling. The policy with the Inflation Reduction Act isn't constructive for it. But if the Dems do take the House, which Polymarket expects, I expect that'll happen, then perhaps you see more constructive solar policy. So for solar could be interesting idea here. I'm not sold on it. I'm just sharing with you concepts we're thinking about. Maybe an end-phase energy. Chart looks kind of horrible, but maybe puts in a double bottom here, and Europe benefits from that. So I think this is an area we want to do more research around. I think utilities, though, are generally in a void. Another reason I don't like utilities is these are bond proxies, meaning they have high dividends. When interest rates go higher, inflation goes higher, bonds sell off, and this was a safe haven. I had this post on Twitter this morning. I was saying I think we want to avoid this. We actually put a short position on the equal weight utilities index, although I think both of them are going to give back. So as these hostilities decline, if they decline, then I think these give back utilities. So that's an avoid for me. I think healthcare has got tremendous value. There's so many good bargains in healthcare. If you have something like 20% of our portfolio in healthcare is characteristic of quality businesses. Here's an example, LabCorp. These guys do medical diagnostics, right? Medical diagnostic testing is through the roof. I get my APOB, LPL, little a testing, measure my lipid biomarkers. I'm getting my coronary artery calcium test, right? All these testing is going up, up, and up. It's one of the reasons why healthcare costs keep going higher. It's because consumers are reading more, getting more educated, taking control of their own health. This is a classic quality compounder. They reinvest and they grow. They invest in a new store. That store gets productive over a certain time period. They reinvest that free cash flow, do it again. I think this theme is going to do pretty well. Your index, the baby boomers, a theme I love. It's below the 200-day moving average too. It's a nice spot. Not a perfect setup. I mean, the peer group, DGX, also a great business, isn't set up quite as nice. They're not both aligned, but should do well with a broad enough time frame. And medical devices in general are quite attractive. Look at the MDT ETF. Medical devices, these are quality businesses. That's what I'm talking about. If you're an institutional investor, you look at a medical device business and you say, gee, your counterparty is US government and baby boomers. That's supposed to have earnings growth. And that demand is not sensitive to inflation. So what do we own here? I think there's a lot you can own here. I think you can buy the ETF. But if I were to pick some names in here, not financial advice, entertainment only, but these are some ideas that we like within medical devices. One is Danaher Corporation. This is an interesting idea. That's one name we like. Got some attractive free cash flow yield. Medtronic is another idea we like. And I'm showing you some of the valuation charts to show you what I look at when I'm sizing up an opportunity. You know, the fundamental idea is that I think the bottom's in. If the bottom's in, then it's about timing your entry. So I think there's good value in medical devices. I think generally around healthcare too, I think we could spend a whole 30 minutes just on healthcare stocks, and maybe we should go do that. What else? I think we covered a lot of ground. Hopefully that was helpful. Check out the Lumida Ledger newsletter. We talk about some of our thoughts. If the conflict continues, I think you'll get another shot to pick up names. But I think the bottom is in. I think there's just a lot of cash on the sidelines. People want to get involved, and you have the conditions for performance chase setting up. You have options expiration at the end of this week. That's probably a risk-off event somewhere around Thursday and Friday. So don't feel like you've got to chase. Markets are technically overbought where we speak. So just be patient, take a deep breath, go touch grass, wait a couple of days, maybe at the end of the week, see what kind of opportunities present themselves. That might be a good way to go about this. Things I would avoid would be industrials, by the way. I think I've said this a few times. This thing is just crazy expensive. You're almost at 2021 valuations. So those would be names like GE Verona and Caterpillar and the Teradynes of the world. I'd be avoiding that. Last but not least, pleased to announce Lumida is launching a crowdfunding campaign, something I've teased for a bit. Go to lumidatribe.com to learn more. Pretty excited. We've moved pretty quickly on this. So look, my thesis is we're going to disrupt Robinhood. There's got to be a better way to invest. I think a lot of apps make money on the back end from payment from order flow. I believe this wealth management category is so ripe for disruption. These financial advisors that are just pushing 60-40 products, they've got conflicts of interest, they mostly play golf. I think that's going to get disrupted with agentic AI. You're going to see AI avatars as advisors that are subject to fiduciary standard. They know their clients' objectives. And I think you're going to see more automated strategies develop out of that too. So we believe we're leaning at the forefront. Download the Lumida Invest app. Go to lumidainvest.com. Check for yourself. It's in the test flight store on the Apple App Store and Samsung. It's not fully released yet, but we will in a couple of months. We've got hundreds and hundreds of daily active engaged users. I'm super, super excited. I use it myself. I'm the primary customer. I know that if I'm happy, then people that are listening to this podcast are happy too. But it is prioritizing insight. It's got a live news feed, and you can check it out at luminatribe.com or go to luminainvest.com, and you can learn more about that. Again, I'll be in Puerto Rico the next couple of days. If anyone's around, wants to get together, happy to do so. We're going to have some small events. We'll be at the Uncorrelated Conference, speaking there with my friends Peter and Jeff, who host the conference. We'll be talking about markets and key themes that we're looking at. All right, thank you all so much for your time. I appreciate it. Until next time, and make it a great week. Be well.